Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures pages on the screen now. These can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both positive and negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. The securities discussed herein do not represent an entire portfolio and in aggregate may only represent a small percentage of a Crescat strategy's holdings. The issuers discussed may or may not be held in Crescat's client portfolios at any given time. This video is not intended to be, nor should it be construed as an offer to sell or a solicitation of an offer to buy any security. If you enjoy our videos, please click on the like button and make sure you are subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Merrick Iwahashi. His contact information is on the screen now and can also be found on our website at crescat.net. So let's get started. Look, we showed this chart back in June. On June 16th is when NVIDIA hit a top. I believe it was a top for this cycle. And the stock has been coming down since, along with a lot of the other Magnificent Seven stocks. Look, the NVIDIA topped first on the 18th of June. The rest of the Mag 7 topped. I think it was around July 10th or something like that. It was early mid-July, and people thought the Great Rotation was starting, and people started using our term of the Great Rotation to apply to a lot of different meanings. You heard it on Bloomberg News and CNBC. People talking about this, and at first everything else besides the Magnificent Seven was going up. Certainly, almost everything else in the S&P 500, even the Russell 2000. But then the S&P 500 also topped in later July, and the broad market started going down. Look at the Russell 2000 today and how much further down it is compared to the rest of the markets. But look, we think we have a major market top that has already played out, and you've seen it in rolling succession, starting with NVIDIA, moving to the rest of the Mag 7, then moving to the entire S&P 500, and now the broader market. And the Great Rotation for us is really about a rotation certainly out of mega cap tech and into undervalued securities and small cap securities, but much more so into undervalued commodities and natural resource related securities, especially in the small cap realm. But let's go on to the next. So what happened yesterday? Yesterday, the ISM manufacturing report came out, and it was the PMI, the ISM PMI report, the Institute for Supply Management. Of all the different purchasing manager index type reports, this one is the most important one, and the Institute for Supply Management. And normally when the manufacturing PMI goes under 50, it's a signal of a recession. More often than not, it means you're in a recession. And it was a big disappointment yesterday, and we're down to 46.8. But it was also a disappointment in new orders and in production and in employment, all contracting at a faster rate of change than from the prior month. Similar, inventories contracting at a faster pace. We have, we also had the prices paid index surprising the other way. This is a stagflationary indicator. It means that this entire report was was a report of the Fed not meeting either of its mandates on employment or on inflation. And this was the day after Jay Powell was out there doing a victory lap, once again with the FOMC meeting. And this is why the market reversed. The market was up yesterday, and then it was down throughout the rest of the day after this ISM report came out, showing slowing employment trends and rising prices paid, and manufacturing PMI overall in contraction, recession territory. Let's go on to the next. So this is a correction from last week. It's the same chart I showed last week, but I said the wrong thing. I said, I'm sorry, Nathaniel did this great chart showing the number of days since the S&P 500 has had a greater than 2% down day. And it's appropriate to show this chart again today because we're having another 2% down day today. But last week we had the largest number of days since 2007, where we have not had greater than a 2% down day, the largest number of days since 2007. What I said incorrectly was that we haven't had a 2% down day since 2007. Which is absolutely not correct. My bad. I'm sorry. I screwed up Nathaniel's great chart and how I talked about it. But lo and behold, here we are, another 2% down day today. And that's the other point of this chart, is that once you start having them, after a big long stretch of not having them, you can tend to have a lot of them in a row. Here we are again. Let's go on to the next. Here's another chart from Nathaniel, one of our analysts, and it's showing the percent of U.S. working age population not employed. There's still a large percentage of the working age population that is not employed, and what this is important at a time when we have rising inflationary pressures and people aren't working. There's opportunity for more people to enter the labor force because they have to go back to work to get a job, to be able to pay for the cost of living. But you can see that normally when you get into a recessionary period, this the percentage working age of population unemployed increases even more. And so if we see more people having to re-enter the labor force, it's just another indication that unemployment is likely to only rise as we have so many signals of an impending recession. It is just unbelievable, from the yield curve being inverted for so long and uninverting to the rising unemployment rate. Of course, the labor market report came out today. Tavi's going to talk more about that. And that's the reason for this follow-on sell-off in stocks today. Let's go on to the next. Where is the value opportunity today? We are still convinced that there is an extraordinary value opportunity in the small cap exploration, small and micro cap exploration focused mining stocks. Gold is already breaking out. Gold is already going to new all-time highs. Why the heck are the junior exploration stocks lagging? Well, it's just the way it's been. It's not always that way. When gold really starts breaking out and moving higher, exploration stocks can dramatically outperform like they did in the 2000s. Look at that. The all-time high for the TSXV composite index, which is where most of the junior exploration focused stocks are listed on the TSXV index. And when they start going up in market cap and investors start putting money into them, because these are the companies that have the discoveries, the next big gold deposits and silver deposits and copper deposits, the stuff that the world needs, these companies have them. But when investors start putting money into them, then they start moving up in market cap. They start getting put into the TSXV composite index because it's a market cap criteria based index, and they only include stocks in there that are above a certain market cap. Well, this is where there's like 2,000 publicly listed exploration stocks that aren't even in this index yet. When they start getting put in there, that's when this index starts going up, when investors start moving money into commodities and into precious metals. They are underinvested, but look how undervalued this TSXV is compared to gold. You know, we say this is the opportunity, this is a value opportunity. You know, people say, well, why are these stocks lagging? How come gold is going up and Newmont's going up and Agnico and the large cap mining stocks, but the juniors aren't performing yet? Well, the juniors have been starved of capital for over a decade. These companies need money. They need money to continue their drilling. On the other hand, they have strong balance sheets. They have low overhead. It's not like these companies are going to go bankrupt. They're just waiting for the money to show up, for investors to start coming back into this industry. And there's going to be a lot of momentum still to come, in my strong opinion. The lag is your friend. The lag is the valuation opportunity today. And we have a killer portfolio of exploration-focused stocks, handpicked by ourselves with Quentin's expertise. Let's go on to the next. What happens when you get in an M&A market and the major mining companies start buying gold exploration stocks for their discoveries? What happens on average is these companies get taken out for 22% of the resource value of the metal in the ground. This is a study that Quentin helped us do on prior companies that were discovered that were acquired for their gold discoveries by major and mid-tier mining companies. And but what's the problem today? You know, we don't have an M&A cycle yet. The majors have not been investing. They're starting to circle, and they're BHP is just bought Filo, or bought 50% interest in Filo. That's pretty interesting. That's something new. But that's one big discovery, and we need to see a lot more of this. Let's go on to the next. So you look at our portfolio that Quentin has helped us put together here, and we have a killer portfolio of discoveries. We have 75 different investments across our funds, and 18 of them are private companies, but that means that 57 of them are publicly listed companies. Many of the privates are pre-IPO situations, and we do have plans to get them public eventually. Some sooner than later, perhaps. And we have gotten a number of our private companies public in the past already. Snowline is a great example of one that we invested in pre-IPO, and look at how well it's done. But overall, these companies are trading for what Quentin would call bugger all. And bugger all means less than 0.5 cents on the dollar compared to the Quentin's estimates of what ultimately the resource will be at these companies. Some of them have official resource already, but it's target resource, and it's based on Quentin's geologic estimates. But that's no different than a major looking at an exploration company when it might come in to buy that company. They're not waiting for the company to put out the resource in all cases. In many cases, they're watching the drill results. This is what we do. We get the money to the companies to do the drilling. We put out the drill results, and we look at our companies. We've got 108 drills operating around the world expected over the next 12 months across our portfolio companies. That's more drilling. That's more greenfield drilling than all the major mining companies combined. And we've had even more drills operating over the last 3.5, 4 years across our companies. It's just that this industry is so starved of capital right now. It's like we're the only fund out there giving these companies money to drill, and these companies are having trouble raising capital because the other investors just aren't showing up. That's okay. We're still putting money to work. And the valuation is incredible. I mean, our portfolio is trading at less than 0.5 cents on the dollar compared to Quentin's estimates of the ultimate target resource that they will be delivering. And we have a lot of gold, copper, and silver discoveries. 57% of our 75 companies already have bona fide discoveries. using Newmont's criteria for 3 or more 100-gram meter drill intercepts on a gold equivalent basis. This is the kind of stuff that the majors are looking for. There is an M&A cycle ultimately coming. We believe it may have just started, but there is so much more to go. We invite you to call Merrick if you're interested in learning more about our portfolio. We can take you through it more in depth on a one-on-one basis. And there's Merrick's contact information. But look, we're going to turn it over as usual to Tavi here to give the more in-depth macro segment of the presentation, and then we'll turn it over to Quentin to go in depth on our companies. Let's go on to Tavi.
All right. Thanks, Kevin. There we go. All right, let's get started. Trevor, do we have the presentation? I don't see it. All right, there we go. Well, thanks. Let's get started here. So this is the first chart I have, which is looking at the VIX index volatility, implied volatility for the next 30 days on put options of the S&P 500 is basically what this is calculating. And some people argue this is not the true volatility index, but for the sake of just the analysis here, certainly we have had a big change in the environment of the last few years. We haven't seen this resistance being broken in a long time, and finally we did. Suppression of volatility has been basically a big thing since the response of the pandemic and how much money printing we've had, and so. I think that this is a big change in how things are likely to be continuing here moving forward. Let's go to the next chart, because it also has an impact, in my view, will have an impact on other things like junk spreads. And you have to think about, what does that mean to the overall market? If you're a company, this will impact you. If you're levered and you take on a lot of debt, what this means is that most likely the cost of that debt is likely to increase, because the volatility of the equity markets tends to lead to the volatility in the corporate debt market. And so, as you can see, the white line is basically showing the difference between junk spreads, so companies that have a credit rating of being a junk, or the lowest or one of the lowest credit ratings you can get as a company. And it is subtracting that by, or looking at the spread versus the 10-year yield. And as you can see, the 10-year yield is actually declining recently, but even though we had a decline in the 10-year yield, it's still higher than historical standards, which it's been suppressing the cost of that spread that we see usually. But as we see turmoil in markets, shown historically here in this chart, we tend to see the junk spreads to widen. And I think this is likely to happen here. By the way, it's not a view of this week. I've had this view for a while. And this one of the things that really hasn't happened. One of those things that things have been sort of irrational for longer than I thought in this chart, for instance. And so now, do I think this is, should I change my opinion? No, I don't think so. Clearly, some of the things are starting to unfold here, and sometimes markets take their time to work out. But I think this is probably one of the things that is sort of the next domino to fall. Let's go to the next chart. Interestingly, if the economy was doing so well, one important question is, what is the actual sector that is doing best year to date? Right now, utilities is about to be the sector that is performing the best year to date, which is shocking. I don't think a lot of people know that. How can you claim that the U.S.'s economy is doing so well on the back of so much fiscal stimulus? To be quite frank, we're still seeing utilities being actually the best performing, about to be the best performing sector of the market here in year to date. So I think this is a reflection of the fragility in the markets. If you're wondering, that pink or the one that is actually leading to the downside looks to be consumer discretionary, as you can see there, and financials as well. And it got REITs too in yellow, following here the pink line. Let's go to the next chart. The next chart. Okay, there we go. So the here we're looking at the employment rate, because I guess we had a big labor data release today on Friday, and not only today but the last few days have been a lot of important data have come out. The Fed has been speaking. Obviously, we've had the statement of them actually keeping rates where they are, opening perhaps the path for interest rate cuts in the near future. Clearly, I think a lot of people are coming to the table that we may see more rate cuts than a lot of people thought. The potential for the hard landing is also becoming more and more of a possibility. But this chart has been impeccable when it comes to looking at indicators that tend to predict recessions. And as you can see here, we're looking at the unemployment rate, the U3 unemployment rate, which is what has been reported today, and went from 4.1 to 4.3. So you can see it's been inflecting higher. But also when you cross that line, which happened in August of 2023, we crossed the 24-month moving average. That line never looked back in history. Every time we hit that line and we went above it, things really deteriorated in labor markets. Now, I will caution a little bit of one thing that I think it's important to point out in this situation of today is the amount of immigrants that we've had recently could play a role here. I've seen some data actually right before this presentation showing, the unemployment rates of folks that were born or foreign folks in the U.S. and it's close to 12% already. And so clearly there has been some of that actually impacting the labor markets already. Some folks thought that, the fact that we see immigration could actually make the unemployment, or I should say the employment a lot hotter. I do think there's clear signs of cracks, but there's some, caveats to the data that we need to pay attention to. If you ask my opinion, I think this white line won't look back. It will probably continue to go higher, just like we saw last times. And that's a very important data point in terms of what may lead in terms of policy making. Let's go to the next chart. Another phenomenon. Can we see the next chart? Looks like we're stuck on this one still. All right, I'll go next. One other chart that I think it's another phenomenon that I would point out to is government jobs as a percentage of job openings. So, we've seen this job openings have been started to really fall recently. But, if you look at the percentage of those jobs that are actually available in the markets today, that are actually coming from the government, we've never seen this number spike as much as it did without being in recession period. So this is a phenomenon that obviously needs more attention because private companies are not hiring as much as they used to. And that is also likely to have an impact on unemployment rates. And so if I was the Fed, I would certainly be paying close attention to this indicator because it seems to me like this is having a similar phenomenon like we've seen in other contractions. Then you can look at the yield curve, and the yield curve is really, I would say, probably the most reliable indicator that we have when it comes to thinking about corrections and potential recessions and so forth. Now, in this chart, we're looking at specifically at the three month versus a 10-year spread. I've recently made the case of why I thought that the short end of the curve was going to fall. And we're definitely seeing that recently. And the steepening of the yield curve has been a very important trade, or I should say investment for Crescat, but also a very important signal to what is likely ahead. And when I heard Jay Powell, I think he repeated this multiple times during his press conference, basically saying that the economy is not even overheating or slowing down substantially. It's sort of in between. I really disagree because I actually, if you look at stuff that tends to really lead to major contractions, I would say that the U.S. yield curve is certainly on the top of that, and it is screaming recession in my view, and probably it's just the beginning. I would suspect that a lot of if we look at across the Treasury curve right now, we're about 70% of that curve inverted, so all possible spreads. It wouldn't surprise me if in 12 months from now we're close to zero, and because that's usually what happens in recessions. We tend to see the abrupt change of the yield curve and the shape of the curve And I think we're kind of in the process of those things. And that's why those changes are happening so quickly every day. And, it's been a high conviction idea we've had, and I think it's unfolding, but there's more to go. Let's go to the next chart. Another one that is sort of an uncanny relationship with recessions that is also starting to point to that direction is the present situation versus future expectations on the consumer confidence. I've seen a chart recently of consumer confidence actually falling apart, and but there is two indices that the Conference Board actually reports. One is called, what do you think about the situation today versus what you think about the situation in the future. As you see, them actually having very strong views about the situation in the present, meaning becoming more bearish, more pessimistic about things in the near future. That usually causes the spread to actually fall. And so we peaked a few months ago, or I should say, not a few months ago, but maybe a year ago. And we've now, this looks to me that is more of a real, or more evident declining trend in this spread. And I would say that this is usually, just like the yield curve inversion, tends to be very abrupt because people change their views very quickly. It's remarkable how the narrative can shift from soft landing to hard landing just like that. And I think we're kind of in the process of that right now. Let's go to the next chart. And then, let's go down to a little bit of a path of or at least a thought-provoking idea, which has been the 2-year yield falling. We've seen this 2-year yield beginning to fall substantially over the last few weeks. And, we are of the view that we're probably going to see this retesting the line, which is about 2% on the 2-year yield, which there's, more to go here, a lot more to go, in fact. And that would be on the back of a Fed that is starting to panic. We're seeing JP Morgan today talking about 50 basis points cuts. I mean, 2 days ago, the Fed just said that there's, that's not on the table. But maybe now with the markets reacting the way they have been reacting, that could be on the table. So, but anyways, let's go to the next chart. Ultimately, I saw Lynn Alden actually on an interview recently, and I thought this was a really intelligent take by her. So, credits to her for saying that. She basically had this idea about, in trading, we often look at patterns that tend to look like higher highs or lower highs. They tend to form long-term or secular movements in different things. And it's remarkable, too, if you look at the Fed funds rate back in the 50s all the way to the late 70s and 80s, we saw a regime shift in which every time the Fed was raising rates, you would see a higher highs on the Fed funds rate. And that actually carried on for decades until we hit that, regime shift at the 80s during the double dip recession, and where we saw the opposite of that. So we saw lower highs, so the prior highs were higher than the current highs. And so that's basically what's been happening all the way to now. And I would argue strongly this is a regime shift as well because of inflation being entrenched in the economy and all deglobalization and all sorts of things. That the way that we responded to the pandemic and so forth, it's been very different than the prior times. And I would suspect that we're probably going to see higher highs. What does that mean? That means that if the Fed will cut interest rates, which it is our view, and will cut probably dramatically, we're probably not going to go back to zero interest rates. We're probably going to go to somewhere close to the prior peak, which was at 2.5% or so. So that would be in line with that 2% on the 2-year yield, in my view. And it's still not priced in at all in the markets. That is a very drastic change in a total reversal of their policy, if that's the case. And notice that those declines tend to be also very abrupt. Outside of, I guess, in the 80s or so, all of them actually, you went from 4 or 5% all the way to zero, just like that. So, I would think that this time we're probably going to go to 2.5%, just given where inflation outlook really is. I can change my view on this, but definitely this is a strong opinion that I think she's right. I think we're at the beginning of a higher highs period for the Fed funds rate. But why do we need to see interest rate cuts? It's such an important question. Let's go to the next chart. It's right here. It's inconsistent. The interest rate policy in the U.S. is completely inconsistent with the rest of the world. as you can see in this chart, the amount of interest payments relative to GDP that the U.S. is paying, compared to the rest of the world, is basically, we need to go back to levels that we're seeing in other countries like Japan, 0.5%, or Germany, 0.6%, or Canada, 0.9%. All these countries are highly indebted. Even Greece, that we all know, defaulted on their debt multiple times and had so many issues. Iceland recently also had issues. Spain, most of the European governments, which are all in second, third, fourth in line, when you look at this chart, are also at least half or so of the numbers that the U.S. is currently carrying on. And what worries me the most is the dollar. Because notice what's happening today. A lot of people are not paying attention to this. I've seen a lot of commentators talk about, the crash in equity markets and all sorts of things. Is the dollar rallying today? No, it's not. In fact, if we go to the next chart, the dollar is actually having one of its worst days in a very long time. Well, that's shocking. Why are we seeing, the markets declining? I thought when you have a margin call and all sorts of things all over the world, people are supposed to be buying the dollar. So when are people going to be buying the dollar? Well, the answer for that is because they're finally realizing that the Fed is going to have to cut rates more than other places. Interest rates differentials really matter. And when you have those being applied in foreign currencies like we're seeing right now, to the degree and magnitude that we're seeing, that is going to have an impact on the dollar in a big way. And so I do think that this is the beginning of a trend, not the end of one. And I think the dollar is poised to depreciate versus other fiat currencies in a large way because of the prior chart, which showed an inconsistency of the interest rate policy of the U.S. versus the magnitude of the debt problem that we have. And that's just getting it started, in my view. So if we go to the next chart now, what you're going to see is, let's see, ATI, activist treasury issuance. So Nouriel Roubini and Stephen Morin both wrote a paper called, that is in the screen here, for Hudson Bay Capital. They wrote basically a paper talking about the activist treasury issuance. Basically, the idea that the treasury is goosing the treasury market. In other words, the government is issuing treasuries in a way that is causing the long end of the curve, 10-year, 30-year, 7-year yields, to actually decline because of the amount of issuances that we're seeing in the front end of the curve. Their point is this is basically the same effect as QE. I thought this was really interesting because QE is T-bills, right? I mean, when you're issuing, or I should say, T-bills are basically cash. If you're issuing T-bills, you're ultimately issuing cash. And so their idea is that, the fact that the government's issuing so many securities and changing the composition of the debt to a short end, mostly, this is having an impact on reducing duration of the debt profile in the government, and therefore actually adding on to the risk-on situation and pushing forward, pulling forward, risk in general. And so this is a really interesting take that I think it's probably what made me think this is actually, if they're right about this situation, that means that the yield curve could have been a lot steeper than what it is currently. In other words, it's being potentially, their case is that it's being manipulated. So you would think that then the yield curve would have been a lot worse in terms of the steepening move than what we've seen so far. And I actually kind of agree with this. But let's go to the next chart. And then you look at how much debt is going to be maturing the next year. Oh boy, that is scary. 27% of the debt. So if you've got $35 trillion, do the math. It's about $10 trillion or so that needs to be reissued in the next 12 months. And so how are they going to issue that debt? Well, if they're doing what the paper said in the prior slide, they're probably going to be doing a lot of that through T-bills. So there's going to be a lot of people having to buy those T-bills and chill very soon. And this is, that's why this obsession of labor markets that even myself get caught on, inflation, and where is inflation going to be 6 months from now? Where is the unemployment rate going to be does it matter? Does it really matter? I mean, the only thing that really matters is how much we're paying in interest relative to GDP versus other places in the world. And if we got to adjust that, boy, we have long ways to go. And I think that's going to have an impact to spill over FX markets, just like today. And I think it's going to be, a lot more of those days. I think days like today are going to be are going to happen more often. And pay attention to the correlation of the dollar versus NASDAQ, which tends to be, when NASDAQ falls, you tend to see an increase in that in the dollar. This is actually very unusual. The last time we saw this was around the COVID crash, which was an unusual time as well, when the Fed actually saw for the first time equity markets collapsing and the treasury market falling along at the same time. And then what caused the Fed to actually step in and buy those treasuries in order to support the treasury market. And so, it seems like there's a few things that are, really, I think, pivotal changes in the macro environment that it's important to highlight. Let's go to the next chart. I think I'm getting close to done. So if you're of the belief that I am, that the 2-year yield is likely to fall, go back to 2%, well, let's go back in history and see what does that do to gold. And, what is interesting as well is that gold tends to like when the 2-year yields fall. And would it surprise you if we see a push towards, much higher levels on gold prices on the back of falling 2-year yield environment? It wouldn't surprise me. So, hopefully I'm giving you a clear picture of our view in which we think that there is going to be a lot of rate cuts in the Fed funds rate, which will impact the 2-year yield and ultimately will impact, in our view, gold. And so, these are very important changes. Let's go to the next chart. Almost done. Well, look at the gold versus the S&P chart, or the gold versus the Russell 2000. For those who don't know, the Russell 2000 is small caps. So the Russell 2000 here is in blue. So gold relative to small caps that's white. The one in white is gold relative to small caps. You're seeing that gold relative to small caps is starting to actually outperform and starting to rise. And you have a little bit of an alligator mouth between that and gold versus the S&P 500. Which one do you think is right? I actually think the white line is right. So probably because the Russell 2000 is a good reflection of the economy. As I said before, it's 2/3 of the labor market. So most likely the blue line needs to follow the white line. And I want to remind you of a research that we've done in the past about the yield curve. Remember the whole research about yield curve inversions and so forth? One of the most important things that came out of that is the performance, the resilience, and the hitting rate of and success of the performance of the gold to S&P 500 ratio at times after the inversion. And I think this is actually starting to, it's been delayed a little bit, but it's starting to show some strength here. We've seen gold break out well above, that 2000 level that's been, hitting in that resistance. The market is starting to roll over. Would it surprise you if we see it again? The gold to S&P 500 ratio rising substantially on the back of the yield curve steepening? Probably not. So, those are important historical lessons that I think a lot of people are ignoring still. Let's go to the next chart. I think that's the last one. By the way, it's something I noticed because I had a presentation maybe 3 weeks or 4 weeks ago in which I went through a list of the gold miners, the GDX breaking out, the GDXJ breaking out. Then I looked at the GDX versus the gold price, and it was breaking out as well. I looked at also the GDXJ versus GDX, so the juniors versus the seniors. It started to break out. But this trend is very important because recently we've had, not only we hit a low in the gold miners to S&P 500. So I'm using the GDX as a way to measure the gold miners. Those are more senior companies. They tend to have cash flow numbers and producing assets. And so you can kind of measure, how much money they've been making. And one thing I noticed too is the fact that those companies are seeing a second wave of cash flow generation, like we saw back in 2018, 2019, 2020 was a big wave of cash flow. And we're seeing that improvement of fundamentals relative to the S&P 500, which clearly is starting now to reflect on the chart. And so, we were saying this the other day, maybe what we really need to see is the equity markets to really fall apart to kind of unleash the gold miners, unleash the gold and not at the same time, but what would probably be the case is that the gold miners wouldn't fall as much as the equity market, and therefore unleashing the whole thing. And that is probably what we're seeing right now. And so it is very, very interesting that this chart is holding there, that pattern. And it wouldn't surprise me at all if in 6 months or 9 months from now we see a breakout from this chart and actually start heading a lot higher. So anyways, I think this is my last chart, so I'm going to pass it on to Quentin Haney.
All right, thanks, Debbie. Appreciate. All I need is for you to tell me when I need to refinance my house, please. Okay. I need to know when all these yields and interest rates are going to plummet and hit bottom. When it hits bottom, wake me up. I'm going to call up the bank and see if I can refinance.
Hey man, at least you have a house.
Yeah, got to be. Well, the bank does, but All right, look, I'm going to jump into a topic that I haven't covered for a long time, but I'm doing it because I'm going to dovetail with an update here that you'll figure out pretty quick. What I'm going to talk about today is nuggety gold. Okay, gold is an interesting element in the periodic table. It doesn't readily combine with a lot of other elements to form minerals. Okay, like multi-element minerals, like quartz is silicon and oxygen, and other minerals like feldspar, silica or silicon, aluminum, maybe sodium, calcium, whatever, potassium sometimes, and oxygen. Okay, those are minerals that are made of multiple elements. Okay, but gold doesn't like to combine with other elements, not very often. A little bit with tellurium, okay, but generally it likes to form in its native state. Okay, like a metal, an actual native, what we call natural gold. Okay, native gold. This is a big nugget here. This was, there's debate about how nuggets like this form. I'm not looking to get into that, but this is an example of how gold usually occurs in nature in some way, shape, or form. It usually occurs as metal, and sometimes it can be very big. Okay, now, you compare this to the size of a mountain. Yeah, this isn't that big. Okay, but for us humans to hold something like that, is extraordinary. Anybody that's held a big nugget like that, you just know, like you hold it and it's like, wow, this sucker is heavy. This thing's like, it's like something out of a neutron star. It just does weird things to you. And I think that's why gold is such a good element to be a monetary metal. It's one of its characteristics that's unique. Okay, it's a very high density, beautiful yellow, other things. We won't go down that road, but I'm going to talk about the nugget effect. Okay, let's go to the next slide. Okay, I'm going to take you through a little mental exercise here. We're gonna pretend we have a sandbox in front of us. This sandbox is roughly 8 feet on a side square. It's about a little over a foot deep. We'll call it a foot of sand. In terms of meters, we're talking about 2.5 meters by 2.5 meters, more or less, with about 0.3 meter of sand in it. Okay. If you kind of do the math real quick, use a density of about 2.2 for sand. There's about 4 tons of sand in that sandbox, 4 tons. All right. So your average kid's sandbox, which my grandson just got one of these recently, has about 4 tons in it, and it's quite a job to carry all those bags of sand. You think, oh, a 50-pound bag of sand, this should go a long way, and then you dump it in there and you realize, oh, wait a minute, I need like 50 of these. It's rather painful to fill up a sandbox. Anybody that's had that experience. All right, but we're going to pretend we have this sandbox, 4 tons of sand in it. Go to the next slide. Now, what I'm going to do is I'm going to take 4 nuggets, okay? And these gold nuggets, each one of them happens to be 4 grams. Sorry, I'm going to take 10 nuggets. We're going to take 10 4-gram nuggets, and we're just going to throw them in the sandbox. And we're going to kind of stir it around a little bit, okay? But this picture here now gives you a rendition of how those nuggets are distributed, and they're relatively random through the sand. There's 10 yellow dots. Count them in the weekend. You can freeze the YouTube video and count them to make sure I haven't shortchanged anybody. Okay, but we're going to say there's 10 4-gram nuggets. That would be 40 grams. Okay, I'm doing this for simple math because I'm a geologist. All right, so there's 40 grams of gold in there. That would mean in 4 tons, 40 grams is 10 grams per ton. Pretty easy, pretty cool. So basically that sandbox is high grade. It runs high grade. 10 grams per ton. Nice. Okay, let's go to the next slide. All righty. Is it me or there? Oh, did we skip one? Nope. Yes, here we go. Stop here. Okay, so we're now going to pretend that we have our little pail and bucket, and we're going to start scooping sand into that little bucket, and then we're going to pour it into a gold pan. Okay, we want to pan out all of those nuggets. All right, now a gold pan holds about 2 kilos, so about 4 pounds of sand. 2 kilograms of sand, we'll say, argument's sake, in a gold pan. And then you're going to start panning it down, and you look and it's like, is there a gold nugget in here? Oh, there's nothing. Yeah, check that. Do another one. Do another. You got to do 2,000 pans to empty that sandbox. I mean, that's crazy stuff. Okay, there's 4,000 kilos, right? There or 4 tons, which is 4,000 kilos. You got to do this 2 kilo panning exercise 2,000 times to pan the entire sandbox, to find all those nuggets that are in there. Ugh, that's got to be painful. If you think about it, taking each gold pan is maybe 5-minute exercise. That's going to take you a few beers and a few afternoons. All right, go to the next slide. Okay, now, because we have 10 nuggets in that sandbox, on average, it's going to take you at least, well, not at least, I should say on average, 200 pans of sand to find just one nugget. Okay, so you have to do that 200 times just to come up with one nugget on average. All right, makes sense, right? There's 10 nuggets. You got 2,000 pans you got to do, and it's roughly 200 pans to find just one nugget. It's probably going to be that 199th pan too. You just know it, based on your luck, right? But it's a lot of work. Okay, let's go to the next slide. Now let's just pretend for a minute we got arms like Tavi there, like just Mr. Muscle, right? And we got a gold pan that can hold a ton of sand. We whip that sucker out and we're just shaking her away. We got a ton of sand in there. So we take basically 1 ton, so 1/4 of the sandbox. We chuck it in that pan. And old Tavi gives it a go. He says, "Here, hold my beer." Gives it a go, and then boom, there's nuggets. All right, that saved us a lot of work. We don't have to do 2 kilos at a time. Tavi just did 1,000 kilos, so 1 ton in one go. Saved us a lot of sweat. All right, now let's just say we do that 4 times. Okay, so we pan that sandbox 4 times, 1 ton each, and we get all the nuggets out. I mean, that's all it would take, right? So we get all 10 nuggets out. Now, okay, here's the catch. So look at how the nuggets might be distributed. I'm just throwing this as an example, but over here in the orange, maybe pan 1, you got 4 nuggets. Pan 2, maybe you got 3 nuggets. Pan 3, oh shoot, I only got 1 nugget. And then pan 4, maybe you get 2 nuggets. Okay, I mean, that's kind of realistically, that's probably your odds of how many nuggets you'll get in any given ton of sand. Okay, anybody that knows my background knows that I had to go through this experience with a certain project in Australia. It's excruciating to take samples of this size, but even here, you're still extremely variable, and in spite of the fact you're taking a ton of sand, because of the nuggety nature, your numbers are all over the map. Okay, now if you take all of those numbers and then do a weighted average, obviously you get 10 grams per ton because you just panned all the nuggets out. But on a per sample basis, it ranges anywhere from 1 nugget, which is 4 grams, up to 4 nuggets, which would be 16 grams. Okay, so you can see the range of gold values you would expect. I will tell you this, statistically, in order to assess a gold deposit or gold sample that has this kind of gold in it, very nuggety gold, you would probably have to take 1,500 kilos, or sorry, 1,500 tons of material to start getting representation here. In other words, you'd have to take humongous samples to get the number, the variability that you see between individual samples down to an acceptable level that you can understand the grade of the material. That's crazy world, but that is likely with a coarse gold system like this. That's likely what you're faced with. Now, let's go to the next slide. What's the punchline out of this? Okay, this whole mental exercise I just took you through is to get you to understand that with nuggety gold, the bigger the amount of material that is sampled and analyzed, the better. Okay, so you need Tavi's arms there. You need to pan a ton. Well, we in the gold industry, when we're drilling and especially nuggety gold systems, we have to be cognizant of this. We have to recognize coarse gold as an issue, and that we have to take appropriate size samples. Okay, now this is an extreme case. Okay, what I just presented, this is about as extreme as it gets. We'll call it end member crazy. Okay, this is out in crazy world. Do we really have to face this level of sampling? Not quite, but we still have nugget effects. Okay, so even when it comes down to drilling, we'll call it a normal natural gold system that has particulate gold, like little nuggets in it, you still have to be aware of this phenomenon. Okay, you have to have an understanding of what I just went through, because you have to take the right sample size. You have to do as good a job as you can to take a big sample and analyze a big sample to get a good number. All right, so let's go to the next slide. Okay, when you're diamond core drilling, in this case, this is HQ core, you produce a stick of rock, a continuous stick of rock. I mean, it's continuous in the sense that, you're trying to basically take a column of rock way down through the ground. Okay, just a continuous column of rock to see what's in the ground. Okay, now, in this case, HQ core, is a fairly fat size, about yay big around. Like if you hold it in your hands, it's about the size of the cup part of your hand here. Okay, all right. But in this particular case, you can see there's some particulate gold. Okay, so you're drilling along, you're a geologist mining, having a nice sunny afternoon, and the driller said, "Hey, man, you gotta come over here and look at this core. There's some pretty good stuff." And then you look down and you're like, wow, okay, there's coarse gold in this thing. That's the first indication you better be on your toes, right? When you sample this and treat it, you want to try to get the best number you can out of this material. Let's go to the next slide. Okay, this little chart shows you the diameter. Whoops, nope, back. This shows you the diameter right there in the middle, the core diameter that's produced from different size diamond bits. Okay, in the case I just showed you, HQ, it's about 63.5 millimeters, 6.35 centimeters. Again, it's about, like I said, about the size of the cup part of your hand here, something like that. Okay, now we're just going to pretend that we've drilled a hole of HQ core, and now we're going to sample it. Okay, and look, sampling is usually on, say, half meter to maybe 2 meter lengths. We'll just call it 1 meter for giggles. Okay, first thing I want to do is take you through an exercise so you can understand how much 1 meter of HQ core weighs. All right, so we're gonna take our 1 meter of 6.35 centimeter diameter core and we're going to give it a density of 2.85 per cubic centimeter, so grams per cubic centimeter. And then we're going to do all the math. So we take pi r squared times 100 centimeters, which is 1 meter long, and then multiply it by 2.85 grams per cubic centimeter, and then divide it by 1,000. Okay, why do we divide it by 1,000? So we can get kilograms. We can convert from grams to kilograms. All right, but if we do that, we take 3.14 times 3.175 cubed times 100 times 2.85 divided by 1,000, we get about a little over 9 kilos. All right, 9 kilos. 1 meter of HQ core is 9 kilograms. In terms of pounds, it's just under 20 pounds. Okay. Now, when you saw the core, okay, you have to saw the stuff in half, split it. That's going to remove a little bit of material. So we're gonna say, okay, the saw, we're losing a half a kilo. Okay, so what does that leave us with? It leaves us with about 4.26 kilograms per meter. That's going to be our sample. That's what we put in a bag. We get all ready, tie up, seal it, and we ship it off to the lab for assay. All right, so half of the core, 4.26 kilo, and she's going off. That sample is going off to the assay lab, and we're going to find out how much gold is in it. All right, let's go to the next slide. Now, let's say that geologist goes, I think I'll fire assay this. Okay, fire assay. Like, unfortunately, we don't have our historic video, so you can't refer back to when I talked about fire assay. But basically, what fire assay is when you take a little bit of material. You basically take your sample, you crush it down, and then you pulverize a little bit. You can take that bit and you put it in a crucible with some reagents. You cook it in an oven, and then you pour out a little button of lead that collects the gold, and then you cupel off the gold and analyze, or the lead, and then you analyze what gold's left. Okay, so without going through the weeds, if you want to look up fire assay, do so on the weekend, take your time with it. But the point I want to make about fire assay, let's say this geologist says, yep, I'm going to fire assay that core. So he submits his 4.26 kilo sample to the lab. The first thing they do is they crush it to 2 millimeter. 2 millimeter is, very, very skinny. Okay. 2 millimeters is like about like that big, okay. It's like that big. It's tiny, right? But you're going to crush it to 2 millimeters. You're trying to crush it so that it kind of makes it all, evenly distributed through the product that you generate. Okay, next what you do is you put it through a splitter. There's little machines that they use to split that material. So your 4.26 kilos is in split, and usually you take around 200 grams of that. So you take 200 grams of the 4.26, and then you pulverize that. Okay, they put it into a machine with a puck, and it shakes it like crazy, like a paint shaker, like this, and it powders the material into very, very fine dust. Call it 80 microns. Okay, so we've taken 200 grams of the original sample, which is 4.26, so 0.2 kilos of 4.26, which is about 4%. It's actually just a little less than 4%, and got down to a pulverized sample. Then to do our fire assay, we take a scoop and we scoop out of that little envelope of powdered, finely powdered sample. We scoop 30 grams. Sometimes they do 50 grams, but in the range of 30 to 50 grams. You might say, well, why is that? Well, 30 grams is basically what we call one assay ton. I don't have time. Okay. So there's a reason for taking 30 grams, but just bear with me. They do 30 grams, 50 grams typically. All right. And then they go through the crucible exercise. They cook it, they cupel it, etc., and then they get the gold out. Then they have their gold content. Okay, but the takeaway here is they only used about 1% of the original sample to get their assay. Okay, now think back to our sandbox exercise. 1% is like nothing. Okay, like if you had that gold pen, 1% would be what? About let's see, there's 2,000 gold pens, so you do 20 pans of sand. Your odds of getting a nugget are probably 1 in 10. Okay, if you went back to the sandbox and did the gold nugget exercise. Yeah, I'm not saying it's that bad here, but the point is 1% doesn't really give you too good of representativity if you have coarse gold. If you have fine grain gold, no problem. Okay, some deposits like Snowline, the gold grains are so small and they're so kind of scattered through the material. No problem. They can fire assay all day long. Don't get me wrong. Fire assay has a purpose. It's great. It's been used for thousands, hundreds and thousands, well, probably 2,000 years. It's fine. If you got fine gold and you kind of just want to get the general picture of what's in there. But when you get nuggety gold, you got to be on your toes, like I said. And this guy, obviously, if he just sent it for fire assay, he didn't. Maybe he gets back his assays. He's like, that's funny. There's only 4 grams per ton in my sample, and I saw lots of visible gold. Well, that's not congruent. Like in my head, I know there should be a lot more gold in my assay than 4 grams per ton. What happened here? This is crazy. Okay, so what's the first thing that person does? So what is better? Okay, what's another type of assay we can go to the next slide? Okay, usually geologists go to is a metallic screen assay. Okay, and in the case of a metallic screen assay, you do everything that you did in the fire assay, but you pulverize about a half a kilo to a kilo. So a bigger sample, not 30 to 50 grams. We're talking about 500 grams to 1,000 grams. Okay, and then you put it through a shaker screen and you assay some of the fine material that went through the shaker screen, but you also assay the stuff that got caught on top of the screen. Why? Because your particulate gold, your little nuggets and stuff should get caught on top of the screen. So you want to have assays for the fine fraction below as well as the stuff on top of the screen. And this is a great way to assay because you're using a bigger sample. Think about Tavi's 1,000 kilo gold pan. Okay, we're using a bigger sample, which is great. And we're doing multiple assays of the coarse fraction and the fine fractions, and then doing a weighted average to find out what the gold content is of that sample. And that's a great technique. Okay, it's used widely in industry, no problem. But here's a catch. It takes you months. Like if you turn in a screen metallic, they're so labor intensive. When it hits the lab's like, oh, brother. Oh no. We have some geologist here that just realized he has nuggety gold, and now he wants screen metallic samples. They got to defer their workers over here to work on all this, screening and crushing and pulverize. They hate them. Most labs hate metallic screen assays. It drives them nuts. Okay, that's why they charge so doggone much money for them, because they're a pain in the neck. Okay, and it will take you months to get your assays back. I guarantee it. You turn in a screen metallic screen submission, 6 months later, you might get your number. Okay, it's just the way it is. All right, and also the thing about metallic screen assay is, at the end of the day, your sample's been destroyed. You've actually assayed, like fire assayed some of the subsets, the stuff on the screen and the stuff below. So you've actually altered your sample. You've used your sample, and it's physically not available to you anymore. Okay, but we now in this day and age, I am pleased to announce that there is an entirely different way to assay, and why the gold mining industry isn't wholesalely adopting this yet, I don't know. I think most geologists are too dang stubborn. Okay, they're just too bloody stubborn to adopt it wholesale. But I can tell you this: Barrick has adopted it. Newmont is starting to adopt it. Other major mining companies like Agnico has adopted it for some of their mines already. They're doing grade control assays in many places around the world with this. They're doing a lot of exploration level work, especially with coarse gold systems. Okay, the drum roll, please. What are we talking about? Go to the next slide. Chrysos. Okay, Chrysos photon assay is a technique that I am referring to. I am very happy to say that we were the first one, I should say myself, but Nova was the first company to use Chrysos commercially back in 2016 or 17. This was developed partly by the Australian government through grants. And it basically is a technique. It's a non-destructive technique that's very quick to turn around assays from samples, large volume samples, like large weight samples. Okay, what does it entail? Well, they basically bombard a canister, a little pot, what we call them, they're pots. They bombard them with high energy X-rays, and then those X-rays go in and they hit the rock particles in the canister, and the atoms that are in those canisters, they give off certain spectra. Okay, gold has its own unique spectra. They can then, after they've zapped this thing, they look at the decay, they look at what's coming out of the canister, and they can estimate how much gold is inside that canister. And it's very, very accurate. We have done millions. I'm telling you, I've done more DD on this in the technique than anybody. I've got the data. There's papers now by people, real smart people like Simon Dominy, that I can show people and show how well this works. It is incredible. Okay. It is incredible, and it's quick. You can basically crush your sample to 2 mil, put it in a canister, and 10 minutes later, you get a number out. It's remarkable. Okay. All right. Go to the next slide. And it is being adopted more and more by the gold industry. I shouldn't be so critical, but why it isn't like just hasn't totally replaced fire assaying at this point, I don't know, but it's slowly catching on. And well, I won't spoil the punchline, but I convinced one company to use it recently or a few years ago. I'll talk about that in a minute. Anyway, so let's go back to our situation where our geologist has a sample, a 4.26 kilogram sample. And instead of doing fire assay, here's what we're going to do. He's going to submit that sample to the lab. They're going to crush all 4.26 kilos to 2 millimeters. So they're going to crush it down to what you see in the canister. They're little chips, like finer than road gravel, but little chips of rock. Okay, so that's the material in that canister. Now, each little canister holds about 450 to 500 grams of material. You never can quite get that much in because you can't screw the lid on and anyway. So you usually do about 420, 430 grams in your canister, but whatever. Okay. The point is you put the crushed material into this canister, and again, you screw the lid on, put it in the machine, bam, out comes a number. Okay, now your 4.26 kilogram sample, you can do 8 or 9 pots. There's nothing that says you can't do more than 1 pot, and you might as well. Okay, if you got nuggety gold, just do the whole shebang. Okay, so you're gonna basically fill 9 pots, we'll say. We're gonna zap them in the machine. It's about $12 to $15 per pot, so it's bugger all. Okay. And we're going to ask the entire core. Okay, so that entire 4.26 kilogram core is now subject to analysis. You got a great big amount of sample here. 4.2, that's as much as you can get out of your core. So you do the whole dang thing. That's incredible. So, all right. And it's non-destructive. Okay, so let's say, somebody's like, oh, I want to verify your number. Well, you could say, well, fine, just go over there because the material's still in the canisters. Okay. You can turn right around and you could do, if you want to do screen metallic, you could go do that. Go do a fire acid, do whatever you want, buddy. Okay. So anybody that's critical, just say, okay, assay it yourself and you'll come back with numbers that are spot on. I guarantee you. All right. But this is the coolest darn thing I know of in the gold space. And it really should be more widely accepted in my view, but let's go on to the next slide. Now, this is how the data comes back. Okay. So you get a simple spreadsheet where you have a column that has the grams of material in each pot, rounded to the nearest gram. You have your assay. So each pot is analyzed. So we have our gram per ton gold in the middle there. And you can see there's a pretty wide spectrum. Okay, think about our gold panning exercise with the sandbox. This is the kind of spread you're going to see. If big noogies ended up in your pot, you'll get big numbers. If no big noogies ended up and there's just a little bit of fine grain gold in there, you'll get smaller numbers. Okay, but this is pretty typical. This is a pretty typical spread that you might see out of one core sample. Okay, so if you look, we have 9 pots. We have 9 pots that assayed that entire piece of half core, I should say. And you can see there at the bottom, it totals 4,260 grams, 4.26 kilos. Here's in the middle, you can see the spread of your assays. On the lowest end, you got 5.32, but up on the highest end, there was a pot in there that had some big noogies in it, so it came back 46.51. Okay, that's like the painting exercise where, one of the 1-ton pans we did just got 1 nugget, and then one of the 1-ton pans we did had 4 nuggets. Right, that's the kind of spread we see in these things. All right, now how do you calculate what was in the whole thing? Well, you do a weighted average. Okay, so you have to multiply the grams of your pot by the grade to get the weight x gold. Okay, so basically think of that like gram meters or something, whatever. But in this case it's weight times gold. It's a numerical factor that you can then total up, and then you divide it by the total weight of your sample, 4,260. And voila, you get this wonderful number. You get a number that is so accurate. It is impossible. Like nobody can argue that is the gold content of your half core, 14.72 gram in this case. Okay, but when you look at the numbers in the middle column, you think, well, gee, wow, that's a big spread. But then when you look at the weighted average, 14.72, pretty cool. You've got a number that is as little, pun intended, solid as rock. Okay, you got a great gold assay. This is the best assay technique I know of. We need to see it adopted more. Okay, so we are effectively assaying the entire sandbox. All right. Let's go to the next slide. Okay, so one of the companies that has adopted Crescat photon assay is Newfound Gold. I'm the guy that kind of pushed it a couple of years back. People that remember that era, they were starting to hit coarse visible gold. This is early on, and there was a lot of noise in the data. Obviously, if you got just heaps and heaps of coarse gold, you're going to have a lot of variability. Okay, and the way they've addressed this now is they have routine photon assay. All right, so basically, well, I pulled this out of a news release. If anybody wants to know where this comes from, I think it was a news release in February of this year where they just announced some results. Can't remember which results, but at the back of any news release that Newfound has, you can find the QA/QC section or the analytics section. You can find this for yourself. All right, but the samples they submit now, they basically do just what I said. If we read through this, they crush approximately 70% passing 2 millimeter mesh. Boom, that's the crush. You don't have to pulverize. You just have to crush. Okay. Then the sample is split. They split it and they transfer it into jars. They call them jars instead of pots, but whatever. Okay, so they basically do multiple pots, which is what I told you. All right, and then they're analyzed by photon assay. Now they also do look. There's core where they have VG. Those they do the entire core. There's just no question. Okay, they do the entire core. But then they have other core at Newfound where there's no VG, but they go ahead and do Crescat assays. But if that sample, the one without VG, comes back with 0.8 gram or greater, they go ahead and they do photon pots on the rest of that sample, okay, just to make sure, maybe there's a bit of VG in here. All right, so they want to make sure they get it. But they have a routine down now, and this is the kind of routine other companies can adopt. Companies that we're invested in and others can adopt. This is a great routine. I'm not going to read through the whole thing here, but they basically have a system where they do photon assay just like I went through. It's the exact same thing I laid out, and it works like a charm. Highly defensible numbers that can be used for 43-101, whatever. Okay, anybody that's worried, this isn't 43-101, BS. Okay, no, this stuff is wholesalely been tested and certified, and they even do it for copper and silver now too. I think they're gradually going to adopt or certify different elements over time. The photons that come out of the thing, like when you zap it with X-rays, every single metal generates its own kind of unique spectra. Okay, so you can, in theory, do most of the periodic table using photon assay. So, and they're gradually certifying elements one by one. So I think they have copper, silver, gold right now, but they're working on lead and silver, or lead and zinc, and we'll see it expand over time. All right, go to the next slide. There we go. Okay, now we're gonna jump in and we're gonna talk. That's the analytics side. Okay, so now we're gonna talk about how gold occurs in natural settings. Okay, and I drew this schematic diagram really fast, but it's intended to illustrate how gold might be distributed through rock. Okay, it's also important to understand that aspect of geology too. Okay, so what do I have? The two black lines denote a vein. It's a relatively flat oriented vein. So we're looking at a cross-sectional view. It's a flattish vein. And in that vein, there's some bands. There's some distinct bands, like it's mainly quartz. Okay, the vein material is mainly white quartz, but there's areas where there's like bands of darker stuff, sulfides, maybe even a little bit of visible gold here and there. Okay, that's pretty typical of a lot of orogenic deposits or things like pogo. Pogo has this kind of a pattern as well. Pogo is a very high grade deposit in Alaska. It's produced something like 9 million ounces of gold. It's composed of a series, like a stack, like I talked about baklava, right? Of walnuts, baklava, think baklava layers. And it's made a wonderful mine. Okay, so, but when they drilled it, okay, they had drill holes going through it like this. All right, so I have 3 different drill holes. I got a purple, blue, and a green. And this is simply to show you the kind of variability you might get in a natural setting, drilling something like a pogo. Okay, so in the purple case, you can see the hole goes through, and it maybe hits a couple of little zones of orangey yellow stuff there, where the goodies are, we'll call it. And maybe it hits 7.3 meters of 4.8 gram gold equivalent. Okay, all right, pretty good, not bad, interesting. Next hole over, blue one. Look there, that one actually hit a pretty robust clump or clot of material, gold-bearing material. And guess what? It comes back higher grade, 6.4 meters of 8.9 gram per ton gold equivalent. And then the one way over here in green, it went through 2 big clots plus a bunch of little bands. Okay, it hits 8.1 meters of 14.2 gram per ton gold equivalent. Okay, so that's the kind of variability you would experience in natural system, right? And most of the gold, like you think about it, you're going to have to sample it 8 times. Like if each sample is a meter long, you're going to have 8 samples or whatever, 7 or 8 samples to get through that vein zone. All right. And obviously the samples that are where the big orangey clots are going to be smoking, and the other ones might be less. Okay, but whatever. Go to the next slide. Okay, so we're going to dovetail straight into news updates. Okay, Goliath announced this week. They announced the first results from their 2024 season, and they hit 35.04 gram per ton gold equivalent over 6.3 meters. That's kind of like what I just showed you a minute ago at in the schematic drawing. Okay, and that is true width, by the way. All right, this is really interesting, and then that's within 11.9 meters of about 15.86 gram per ton gold equivalent. Now there's more assays to come. Okay, so in this drill hole, which is number 235, there's more assays to come. They talk about those in the successive bullets there. These holes are fairly, because the veins are fairly flat, these things are hitting the things more or less dead on like this. So the drill width is pretty much close to the true width in each case. And I just realized I got 5 minutes. I got Jimmy here. Go to the next slide. Here's what we see in the core. Okay, the white quartz vein is the quartz. That's what the baklava layer, right? Now, in this case, you got quartz, and then you cast your eyes down, and then there's more quartz down there towards the bottom. Okay, there's a little bit of dark stuff in between the upper quartz area and the lower quartz area. Whatever. Sometimes veins split and come back together, and think of them like a braided river or something like this. An anastomosing river. It doesn't bother me, but the point is, basically starting at the top in the 1, 2, 3 rows down, there's an area where the quartz starts. You can see it right away, where it turns white or light gray. And you got quartz for a few rungs, a little bit of black, and then you got more quartz, and then it ends in the bottom row. Boom, your quartz ends. That is the 6.34 meters that runs the 35 gram gold equivalent. You can see the numbers down at the bottom. Okay, now I've put little yellow arrows there to point at the goodies. Okay, so remember how I told you there's clots of sulfides and gold, and then there's little wispy bands and stuff through the quartz. I've simply put arrows, yellow arrows, noting where there are goodies. Okay, so I would expect if they sample this on 1 meter, I would expect, oh, wow, there's a lot of gold. Okay, wow, there's a bunch of gold here. not so much gold, but there's another big one. Okay, that's the way this would look in assay. I don't know what the details are, but that's how this is in nature, and that's how you sample these things. Okay, anybody that's this, oh wow, they're smearing. No, they're not really smearing. Okay, you can see a structure here, this quartz structure, and that's the way gold is naturally distributed in a system like this. Doesn't bother me one iota. You've got about 6.34 meters. That if you think about this, if you turn it, okay, and you're looking at it from the side, it's very, very much like that diagram that I just showed you. Okay, the couple slides back. Go to the next slide. So we're going to take a look at this puppy. Okay, so we're going to take the table they had from their news release and look at my schematic drawing. Okay, first of all, they actually had another drill hole in this news release, hole number 236, and it had a lower grade interval of 6 meters of 4.14 gram per ton gold equivalent. Okay, so we're gonna just say that's kind of like analog wise. That's kind of like the purple hole that I had over there on the left-hand side of this schematic. Okay, but the 35 grammer, that's more like the green hole because it did hit some big clots where there's sulfides and VG and so that's a small, but you can get these things. Basically, you can drill two holes next to each other and you can see that kind of variability because of the way the veins. Okay, but that's what this system looks like in detail. This is what the veins at Sherbet and so forth look like. Okay, let's go to the next slide. Now, before I leave the topic of Goliath, I want to point out that I have pushed these guys. When they came out with this news release, I got on the horn with the team and I said, please, please, please try photon assays. They're going to, okay? They're actually sending samples right now for photon assay. So they are going to do everything that I just talked about, which is wonderful in my view. Okay, so we're going to see the company adopt that going forward, and we're going to get really, really good data here. Usually what I see with photon assay is that it brings the spikiness down a bit, but it usually brings the lower grades up. And it usually results in a really solid picture of, of the gold in this style of mineralization here, like at Newfound. Okay, and they are seeing, by the way, why would you do it now? Well, because they're seeing more VG in the area they're drilling in. Okay, they've been drilling for, 3 or 4 years, I think. And all of a sudden, they're getting down into what are clearly high-grade feeder structures. And they're going to start changing their analytic technique to get this better detail. At the very last bullet down there, notice they have 10 vein domains now identified. Talk about baklava. I mean, you got 10 veins now that have been identified. This is a very robust system. As we understand more, we get better, better and better assay data. This thing, I think, will shoot the lights up. Okay, I'm very, very pleased to see this. I'm very anxious to see what the next assays bring, and also what the photon assays bring here shortly. Go to the next slide. It's all right. I'll just put my skates on. Like Snowline had a brief news release this week. They announced that they have their 43-1 technical report out. I'm going to review it over the weekend. I did look through it on a cursory level. Very detailed, very conservative. Okay, so the resource, in my view, that's a conservative number and a conservative way to model things. I will dig into it more over the weekend, but the exploration update is what I wanted to point to for a little bit of indication of what we might expect out of the company over the next few months. They are drilling like mad. They have drilled already 16,000 meters of their 25,000 meter program, and this includes drilling at Valley, the infill and step out holes around Valley, as well as holes at Jupiter, and then they mentioned the other targets like Cujo and stuff. Aurelius, don't forget Sydney. I think Sydney looks very good too. I don't think it's mentioned here, but the point is, these guys have a heck of a lot of news coming over the next few months. All right, go to the next slide. Laura put an update out about ISCA, the silver polymetallic system in Bolivia. They basically gave an update on their PEA work that they're doing and where they're focusing on optimizing through engineering and potentially ore sorting, upgrading to enhance the grade, so they can build a smaller mill. I think that's a really intriguing outcome out of this. They also have talked about needing to drill some more to get a better drill-defined, higher-grade resource put together. Yes, I think we know that. I think we're aware of that. where is the company going with this? Look, they got a lot of smart people in this company doing a lot of smart technical work. They need some cash, is my bet. Okay, but they have a good story. We're supportive. We want to see this succeed. Go to the next slide. Okay, I think this is the last one. Juggernaut put out an announcement about visuals on drilling at the Midas property. This is this Kokomo target, which is a VMS system. It's actually near Terrace, it's not far away. I think you can order pizza and have it delivered by helicopter within about 10 minutes. Pretty good setting for most geologists. All right, look, this is a VMS system, very unusual age. It's actually older than most in the region. What did they hit here? Okay, we don't know yet. I will refrain from saying, oh, you know, this is the best thing since sliced bread. I'm not sure. Okay, but they did have at least some meters, some intervals within the 84 meters that displayed chalcopyrite and stuff. I'll show you a photo here in a minute. Okay, we've got to wait for assays. It's very important for people to understand. Got to wait for assays, but they're drilling and they're seeing sulfides. Irregardless of what the assays are, it does look like they're in a pretty big system. A small VMS would not generate an 84.5 meter hole. You know, whether they hit high grades, we got to wait, but they're doing a 3,000 meter program. We'll see what they come up with. Go to the next slide. I think we have one photo of core. You can see here some of the fresh core that's come out in 2024. It does have a lot of chalcopyrite through it. There was some in the core last year too. They did have, you know, little pops and whistles of higher grade. This time, are we going to see better grades? I don't know yet. Okay, I can't really tell from that core how much chalcopyrite is in that, but there is a lot of sulfite. You can see that kind of weird brownish color or tinge to it all throughout. Okay, I think that might be it. Go to the next slide just in case. Done?
Looks like it.
Okay.
Kevin, on you.
All right. All right. Thanks, everybody. I think the opportunity is really incredible right now to be putting money to work in the precious metals exploration space. There are so many great stories out there that are good companies, bona fide discoveries. And yeah, these companies need money, but that's an opportunity to, you know, to come in and get these companies while they're cheap. You know, stocks may be down because people know these companies need to raise money, and that money raising is further dilution. But that's just how the exploration industry works. You know, we bake that into all of our models. We plan for future dilution. That's our opportunity. How we come in into the pipe deals. We put money into the private placements. We get the money to the companies to do the drilling. I'm not saying that people have to participate in the private placements. I'm certainly not promoting that at all. That's what we do. That's what we do within our funds. But you can buy these stocks in the open market too. And again, we're not recommending any securities. We are talking about, you know, if you're interested in our funds, we are suggesting you reach out to Merrick, and you know, let us do the work here. There, we have an incredible portfolio of discoveries. They're deeply undervalued in our analysis, and I think there's a lot of upside potential ahead. So let's, you know, I think the great rotation has started. I think the market for large cap and mega cap tech has already topped out, and we are heading into a stagflationary recession. So, you know, if ever people are going to start looking to precious metals and looking to allocate to gold and an activist metals type strategy, I think it's now. I believe we're going to be seeing a lot of money coming into this space now that the rest of the market is finally rolling over. And look, it's certainly rolling over. You know, people, I mean, I hear it from people at the golf club when they talk about their portfolios and what the market did, you know, yesterday. And you know, people are talking about it. People are going to be looking for something different. Anyway, Tavi, any final comments?
No, it's been a bloodbath week. It's sort of not shocked to see this move in the dollar, and I think there's more development there to unfold. Reminds me a lot of the beginning of the Treasury move back in 2021 when it started to fall apart. Nonetheless, it is interesting how Bitcoin is actually down 2.5%, along with Nasdaq down exactly 2.5%. Well, that correlation is checked, so that's interesting. But nonetheless, I think there's a lot of things happening. Macro usually is quiet, and then lots of things happen in the course of a few weeks, and just feels like we're in one of those few weeks right now. But anyways, all right, we're going to be back next week with more. Another presentation next week will be, if you're interested and want to learn more, I would suggest you speak with Merrick, and you can talk to him about our funds and what we do. Also, if you want to be notified of our upcoming videos, I would highly suggest you to follow our page on YouTube, and that should help you to be notified of our upcoming videos and so forth. But we'll be back next Friday as well. But thanks everybody for watching. By the way, it's been a great audience. We hit over 7,000 people here live, which means we're probably going to get a record views in this video. That's so thanks everybody that is still here listening. 7.256 actually to be precise. So thanks everybody. It's increasing as I speak. So anyways, all right. Thanks everybody. I will stop this now. Thank you, and we'll see you next week. Take care.